Okay, that'll most probably good to start. So, welcome everybody. Thanks everybody for dialing in. This is our Q3 overview of the ODCE index numbers. I think we've got over 1,000 people registered for this quarter, which is great. So over the next 50 minutes, Robbie Tangent. Nice to see you there, Robbie. And who's head of our valuation advisory business, and myself, Phil Tiley, who heads up the performance analytics side of the business. We'll take you through the latest ODCE numbers. The performance benchmarks we access from NCREIF, that based on all 26 ODCE funds. Within ODCE, we have a valuation data set over 175 portfolios. We then match those up with those ODCE funds to provide added intel into the analysis, utilizing a host of valuation metrics. For those that are new to this analysis, we'll explain more about that as we go through the results. The webinar is kind of part market insight. It also serves as a precursor to our one-to-one client conversations, who are also members of NCREIF, where we replicate this analysis on a comparative basis. We look forward to carrying out these discussions in the weeks ahead. Before I pass over to Robbie, I just want to stress how this webinar is very much a collective effort. So a word of thanks on my behalf to everyone involved in the process of pulling this information together. The performance team that work alongside me, the wider advisory business unit that work with the valuation data from our clients obviously, thanks to them providing us with privileged access to their data, and then obviously to NCREIF for pulling together the benchmark numbers on the performance side of things. And thanks everyone here for tuning in. We do have a few poll questions that we'll run through. So first one I'll maybe just pick over to Robbie. It's really to gauge the mood of the people we have online today. So Robbie, maybe over to you just to pick that one up first.
Sounds good. Go to the next slide, Phil.
Yeah.
Okay, perfect. Thanks all. Thanks, Phil. Right. So to kind of the beginning, right? So first poll, how has 2022 compared to your expectation at the start of the year, right? So what we meant is basically as of today, if you look back in the beginning of the year, how is the real estate market compared to your original expectation? Is it better than expected, worse than expected, or around about the same, basically about the same, right? So from my perspective, we're going to give about 15 seconds for people to enter the answer, right? So from my perspective, it may be about the same, maybe kind of get worse than expected. But generally, this economy may be kind of worse, but real estate seems to holding up a little bit better on the private market side, right? So maybe that's about the same, right? So what do you think, Phil?
Yeah, if I take an economic lens to it, I feel that people will most probably say worse, but let's see what they say.
Sure. You're correct. About 54 is worse, is about 29 is about the same. So that's kind of pretty much what we kind of expected, right? So, but about 17 is actually better than expected, right? So definitely quite interesting. Let's go to the next slide.
Yeah, you got that there.
Yep. Yeah, so basically before we start, right? So in here, this is what the question we asked last quarter, what do you expect the total return for third quarter would be, right? So is it negative or is it slightly positive or more positive? You go to the next slide, Phil. We'll see kind of what the answer. So you can see 56% of the audience last quarter indicated will be slightly positive, so i.e. value will be holding up, and it's only about 14% that indicate will be kind of a below 1% or negative, right? So about 85% generally of the audience from last quarter indicated it will be more positive. So I know people are getting the number already, but drum roll, Phil. So what does the 3Q look like?
Okay, and I was also in that kind of middle bracket as well, but so the overall performance number did finish in that bottom bracket, so it did amount to a relatively tepid 0.4% return. So just to clarify the makeup of that number, so we're focusing on this presentation on the pure real estate side of the ODCE. So there's no leverage, there's no cash, and we're looking at how performance levels have actually played out, the pure real estate performance levels have played out. We should mention that if you've got questions, please put them in the chat line as we go through the information. These are total return numbers, so that's income and appreciation. So within that performance number, appreciation returns have been that 0.4, did turn negative this last quarter. But the table, just the top line, shows just how quickly the market's really ground to a halt. And in 9 months ago, we were kind of waxing lyrically about record-breaking levels of performance, which actually remained in the kind of 6% territory in the first 3 months of this year. That was followed by a marked kind of slowdown in Q2, returns down to 3.7, and over the last 3 months scaled back once again even further, and now barely positive. At the top of this chart, we're separating out the stabilized from the overall return. The stabilized excludes development properties. Performance-wise, there's nothing in between those two sets of numbers. In previous quarters, developments have typically added something to performance levels. The fact that we're no longer experiencing that is another maybe indication that the market seriously is experiencing a level of slowdown. So what about the shake-up? And there has been a shake-up across the different sectors, which we color code here in terms of whether they're north or south of the ODCE overall operating stable asset rate of return. First point to note, if you look between Q2 and Q3, is that downward trajectory in performance levels is evident in each of the main sectors. Industrials saw the largest cutback, 6.1 to 0.9%, and actually that enabled others to move ahead of them to the top place in the ranking. Somewhat timely, given that alternatives is going to be the focus of the upcoming NCREIF conference in Orlando. In that other sector there, we've got a mix, but most of that, largest part of that is self-storage. Got senior living and healthcare in there. We've got some data centers, some MOBs, and some life science, but most of that life science and MOB is being categorized under offices. NCREIF are busy kind of undertaking a reclassification project, which will help give added clarity on how kind of within those sectors we can further isolate the different subtypes, and we do a little bit of that ourselves later on. Elsewhere, apartment returns dropped to just 0.4%, which has actually seen them drop below retails in the quarter. Retail's not a great deal better off at 0.6% returns, and that's a percentage point shy of where that sector was in Q2. Offices definitely in the red there, still languishing at the bottom end of the order, experiencing yet another performance setback and returns there, turning negative over the last 3 months. The other point to note, and just single out the bottom there, is the spread in returns across the sectors. So there's now only around about 3 percentage points separating the top from the bottom end sectors, and that's definitely one of the tighter distributions we've seen for some while. Only 3 months ago, we were looking at spreads across the sectors of around 13 percentage points. So how spreads across sectors impact on portfolio level returns is an important point for us to think through. When you apply attribution metrics to these results over the last year, over kind of on average about 60% of performance variances of portfolios against the ODCE was a product more of how they're invested into each of the different sectors, and 40% was down to property specifics, how their properties have performed within the sectors. You've run that analysis just for the Q3 period, and it tilts very much the other way. It's almost 85, 15%. And attribution theory shows that as markets start to level out on a fund by fund basis, the variance increasingly becomes more about the property specifics. I think the long run average it's always quoted is about 65 property, 35 allocation. It feels like we're moving definitely to a period of more property specifics. It's not as simplistic as that. Obviously, there's also variances within the sectors which are based on allocation versus property specifics. So I'm kind of digressing a bit, but that's the kind of detail we get into when we talk to our clients. But I thought it'd be worthy of a note given we're seeing that much close to clustering of returns across the sectors. Changing tack, this looks at the results on an annual basis and kind of reminds ourselves just how polarized the market has been. This goes back the last 3 individual years, and we've got the 3-year annualized where we're compounding those numbers up, and it also shows just how strong real estate has been performing. So an annualized rate of return of nearly 11% per annum, and you can see how that stepped up to almost 18% over the last 12 months, even with that Q3 slowdown. And whether it's kind of year 1 or year 2 or year 3 of that, you can see from the color coding that sway the green that industrials have really eclipsed everything else, almost 9 percentage points per annum ahead of their closest rival on a 3-year annualized basis. And actually, unrelenting really over the last 2 years, returns over 30% in each of the last 2 years. Those alternatives have also been typically strong performers there in the green. Apartments kind of neutral in the white there, taking hold of the middle ground just ahead of the ODCE when you look at things on an annualized 3-year basis and coming more into their own over the last 12 to 18 months. If you look at down that kind of 3-year annualized column into the red zones there, offices and retail's very much cut adrift. Retail's are seeing more of the earlier performance setbacks, that negative return there traced to effectively the immediate onset of the pandemic. Since then, growth had returned to the retail sector. That's then allowed it to move ahead of offices, and offices clearly a sector clouded with a level of uncertainty. So what are those different kind of performance levels meant for kind of portfolio structures? And we thought with a lot of newcomers to the call this quarter, it might be worth it reminding everyone about the makeup of the Odyssey portfolios from an aggregate standpoint. And this is something we're often asked about. So I think I recall this is from my geography days. This is called a sand diagram, and I've extended the series back. There you got the full 10-year spread there. The weights of the sectors are marked out in the color coding. And you can see that during this period, kind of portfolio structures within these Odyssey portfolios have pretty much been turned on their head, and that's in the space of a decade. And most of those swings actually occurring over the last 5 years. I mean, offices, which used to be close to about 40% of value, they're now less than 25% of portfolio value. Retail value weightings have dropped to 10%. And those two sectors, which used to account for about 55% of all fund values, are now collectively just around about a third. And that reduced share across those two has really been taken up, or maybe kind of explained another way, caused by the growth of the industrial sector, which has gone from 14 to over 30%, and the emergence of those alternatives. The red bars are the apartments, and they've been steadily creeping up there, about 28%. Now, some of these shifts in weight will be down to investment trends, but the largest aspect of those structural changes, and we've looked at the data, is down to the performance levels that have been playing out on a sector by sector basis. But let's get back to the overall returns. This next chart unpacks the returns into its income and appreciation elements, helps put the current period into a level of historical context. It illustrates, see from that dark line, how quickly or dramatically the market has tapered off over the last 3 to 6 months. Returns, yes, they're still positive, but the main point of note this quarter is that red bar has turned negative for the first time since the onset of the pandemic, and it brings to a close that 7 consecutive quarters of growth. And during that growth period, values have risen by 28%, and that kind of really does kind of make that write down of just over 2% around the initial period of the pandemic feel like a distant memory from an appreciation standpoint. And actually, if you strike the start there, then values are up net 25% over the last 3 years. But that growth looks to have now drawn to a close. And this is where it gets interesting, because when you actually look at the makeup of that appreciation and how that scaling back has occurred, and what we're able to unravel at ODCE using our market valuation data sets, how much that movement in values is a product of either pure economic fundamentals versus what might be termed more the investor sentiment. So on the next chart, we take the red bar here and we transpose it onto the red line, and then we bifurcate or decouple that appreciation red line into what's termed the yield versus the cash flow drivers. The yield effect in the yellow is the impact of what might be termed the kind of pure pricing levels on value. So that's the impact of change in discount rates, change in exit caps. That's the kind of investor sentiment, the capital markets part of the equation. For the cash flow, the blue bars, we're identifying the impact on value from the changes in those kind of 10-year forward projected cash flows. That's more the occupier demands versus supply side of the equation. Clearly, a key topic in the wider fiscal markets have been the moves by the Federal Reserve. Increasing interest rates happened again yesterday to combat rampant levels of inflation. And that increase of cost of capital has been filtering through into real estate back in Q2, which is when we saw kind of pricing metrics for real estate start to edge back out again, having a negative impact on appreciation. You see that yellow bar back in Q2 dipping below the line. There's not a direct relationship between movements in 10-year treasuries and real estate pricing. Robbie, I'm sure you could say a bit more about that in a second. It's more how those rate rises are perceived, which is partly down to the wider narrative on risk. And that increase of cost of capital became further exacerbated in Q3. I think the 10-year treasury actually moved out a further 80 basis points between the midpoint of the year to the end of Q3. And also valuation yields have moved out, taking a further 2.5% off values in that Q3 quarter. We'll provide more specifics on those actual yield movements in a couple of slides, but the overall change in value, certainly over the last quarter, then also relates to the cash flow side of the equation, almost more so the interplay between the two component parts. So alongside the kind of fiscal adjustments, there being clear challenges facing the wider economy, it feels like sentiment swings there may have moved a bit more in the last 3 months. The Wall Street Journal running a survey of economists, I think back in Q2, that showed a probability of going to recession up at 44%. They reran that survey of the economists in October, and that moved out to 63%. Back in Q2, we weren't seeing any real economic concerns at a headline level from the cash flow standpoint. Those cash flows, those blue bars, still having a positive impact on value. And in fact, actually that cash flow metric stepped up in order of magnitude in that Q2 period, ensuring the appreciation was still pretty healthy back then. You roll forward to Q3, and those cash flow gains you see from that size, that blue bar, have scaled back. And put simply, we no longer have enough growth in real estate fundamentals to override those increasing pricing metrics. And the trade-off between the two effectively left values at a net standstill. You throw into the mix the money that then continues to get spent on real estate, and the net result is a negative return on appreciation over the course. So Robbie, what's your take really on the bifurcation that we're seeing playing out at the moment?
Thanks, Phil. I think I agree, right? I think that generally there's uncertainty in the cash flow side, right? So there's no question there, right? So, but overall, like on the cash flow side, I don't think that's necessarily the true issue. Still positive, right? So to some extent, inflation helped the cash flow side of real estate, right? So, but the growth is definitely being tapered down just because uncertainty with the economy, right? So I think this time around, the headline's more about capital market, right? So as you, of course, we know, like a 10-year treasury, for example, have moved up from 2.98 in the beginning of the second quarter, at the beginning of the third quarter, it moved up to kind of in a sense 3.9 basically, also at the end of the third quarter, right? So that's about 85 basis point move on the capital market front. And today you can hear it's kind of like a 4.15 today, right? So, but generally as well, we know the bank are pulling back, right? So structured credit issuance slowing, and special servicers actually gearing up for more distress, right? So we all kind of been financings on hold, right? So balance sheet lender pretty much have filled up their quota, the allocation for the year already. Many of them already filled up in June or July, right? So CMBS is on vacation, right? So especially long dated bond is still on vacation, right? So, and the short-term financing as well is much more difficult, right? So because you have the higher interest rate cap, right? So it's higher swap rate, so make it more difficult on the floating rate side as well. On the other hand as well, then on top of that, basically denominator effect that everybody aware of, right? So that's slowing down the capital flow in there. And before we step, Phil, I think there's one question asking what is the capex effects, right? So
the capex effect is effectively just the movement in values net the amount of money that needs to be spent on properties. So, and that's the actual money spent during the quarterly time period.
Perfect.
Okay. Thanks for those inputs there, Robbie. And this is an overall set of numbers as well. So those rate changes and cash flow movements do vary across the sector. So let's get into that detail. So here you want to be focusing on the right-hand side. We're separating out the 4 major food groups, but we've got the others which we'll separate out in a second. Just focus on the right-hand side, the Q3 bars. First point to note is that the pricing offset the yellow bars, which stepped up in order of magnitude in each of the 4 major sectors. But it's the growth sectors, the apartments, the industrials, as we saw in Q2, that have again been the most effective, holding values back there by about 3 to 3.5%. And these are clearly sectors where underwriting levels have been brought down to historically low levels in what's had been a period of record low interest rates. Office and retails also saw their yields move out, but the outcome on the red line, the appreciation in Q3, was really all about then again that interplay with the cash flow piece. Cash flows, the blue bars, have been scaled back across the board, still accretive to values in most cases, and for industrials, they've just about been sufficient to mitigate this softening in pricing. So that's left that as the one sector, or the one of the 4 main food groups, where appreciation was still just net positive, albeit only just, whereas for apartments, that reduced cash flow growth was not enough to pull back on the values versus the rate changes. So appreciation there net negative. If you go down to the bottom right-hand side, retails, the adjustments are pretty minimal here. Cash flows are still trending in the right direction, but only a slight uptick. And as I assume households again are very much tightening their purse strings, and as yields moved out, then values did edge back down again last quarter. Offices is the one dual negative. So here we have scaling back of business activities, the whole strategic rethink about the utilization of office space, and that's putting downward pressure on cash flows. Add in the rate rises, and this was the sector with the largest write-down in values in Q3. Now, I've just swapped out the industrial for the other, which is mainly self-storage, and that's the one sector where cash flow gains actually continue to strengthen in Q2. Yes, yields have moved out, but not as much as they did in the apartments and the industrial sector, but leaving kind of appreciation a little bit more net positive for the quarter on that sector.
Question, Phil. I mean, on the other category, one, what is included in the other, right? So is it, I know you indicate self-storage, is it any other asset type as well in there? And second, I see a lot like the gray bar, the CapEx bar, all the other asset types seem relatively stable. Even the other seems stable until until this quarter, right? What's going on there?
Yeah, okay. Well, other primarily self-storage. I think 65% of other is self-storage. You've got some senior living and healthcare, as I said at the start, some MOBs and some life science, but most of that does fall into the office sector, and the data centers are primarily kind of falling into the industrial. So hopefully, and we do break that out later on. In terms of, and there's some SFR in there, and actually it's SFR and a few student accommodation schemes, which are actually causing that larger CapEx piece. And this is where schemes are being extended out. And in a number of cases, these are treated as collective assets. So in effect, any acquisition is being treated as a property extension or a part purchase, which then falls under the capital expense piece, whereas typically an initial purchase gets picked up at the overall fund financial level. So it's a bit of an anomaly in that respect. So think of these as properties that have just been extended out, and you can imagine that with student accommodation and SFR schemes. That may skew the cash flow a little bit on the way up, but it still does leave that sector a net positive from an appreciation standpoint. Hopefully that kind of clarifies that. Okay, let's sticking with Q3 and just delving a little bit more into those kind of yield and cash flow variances and how they make up that appreciation piece on the left-hand side. I mean, it's ordered in terms of appreciation there. I thought what was interesting when you sit the two alongside each other, while the focus is very much, the talk is very much on the pricing side of things, it's the variances in those cash flow levels that have really determined the hierarchy when it comes down to understanding the range of the appreciation returns across the major sectors. But pricing is obviously a key topic, so let's dig into that first. So on the left, we've got the cash flow effect from this slide here, and then the actual movements in those yields. So this shows how yields have really moved out about 3 to 4 times as much as they did in Q2. The lighter shaded bars behind are the Q2 movements in those actual discount rates and exit caps. The variant between discount rates and exit caps across the sectors are pretty much in step with one another when you think of that. The larger adjustments were in the industrial, the apartment sectors. That's off lower bases, so then more of a pullback in value in that respect. So, Robbie, the relatives make sense, and it's the sectors that have seen the largest movement in pricing in past quarters have seen more of that reset, more of that reverse. But what's your thought, I guess, on the extent of all those yield movements when you look back over the quarter and the levels at which markets are currently priced?
It's perfect timing, Phil. I think the way I look at it, let's address the elephant in the room, right? So people kind of look at it, the 10-year treasury have moved up 85 basis points, while the pricing is only move up less than 25 basis points, right? So both discount and exit, right? So again, kind of high level, there's one question as well, how many percent of portfolio is being valued on this quarter? I was at 100% of them required to be valued every quarter on Odyssey, right? So they're all external valuation, right? So basically in here, the way I look at it as well, one, cap rate and price generally do not have a strong correlation with interest rate, right? While they're positive correlation, they're not necessarily connect a very good correlation, right? So when we look at valuation, appraisal are generally they're not market maker, right? Appraisal have to reflect the market, right? So And today's world is much more difficult, right? So there's varying view within client, there's less transaction, even there's transaction, basically, even within transaction, there's differing view as well, right? So take example, industrial in the West Coast. If you're trying to do evaluation of industrial in the West Coast, you're gonna research, you're gonna find 3 deals, right? So one deal is a sell leaseback, short-term sell leaseback. I technically can call it fake-in. It's a one-year deal. And its implied cap rate based on kind of the number, it kind of commit 3%, right? So it doesn't seem to be much adjustment. Second deal, we also recently closed as well. So you can see that the deal actually 4 year remaining on leases, going in cap rate 2.7, right? So we kind of say, whoa, we should not be less than 3, but someone did acquire at 2.7. Granted, the stabilized cap rate around like mid 4.5 to 4.75, right? So in year 3 or 4. And finally, then there's a deal on the escrow with credit tenancy, longer term leases that basically in the mid 4 cap rate, right? So who's right, right? So all 3 of them is below the leverage, right? So all 3 of them are negative leverage, right? So if you're trying to borrow money today at that time, right? So maybe your borrowing cost is like a 6% interest rate. So all these deals are basically negative leverage, and 3 investor willing to buy industrial at that pricing, right? So and then appraisal job is to reflect the market. So we have to triangulate based on this deal. What is that going to look like? Surveying the investor, surveying broker. Generally, there's movement in pricing, right? So no one questioning that, right? So also tapering out in growth rate. No one is questioning that, right? So I think that's what reflected in the discount and exit cap rate, right? So by appraisal trying to triangulate a different view in the marketplace, different transaction in the marketplace, and survey, right? So.
Okay. Thanks for the clarification on that, Robbie. I think I'm glad I've got my job in the business and not yours. Let's move across to the cash flow side of things. So as I said on this slide, the major variant when it comes down to appreciation is cash flow. I mean, yes, the pricing movement is crucial. And I think that's a hot topic at the moment. But actually, if you look at the spread in returns, it's really on the cash flow side of things, which is the key variant, really, and which we then relay here to a series of 6 key valuation metrics. The bars here are then showing percentage changes in those metrics over the quarter. There's not a perfect science to this chart, so you can't add up those bars to see the impact on that cash flow effect on the left-hand side, but it gives you a sense of what's positive and negative impacting on those forward projected cash flow trajectories. So cash flows on the left, generally in the ascendancy, having a positive impact on value, and we can see more greens than reds on the board. Occupancy, contract rents, market rents, all greens, all moving in the right direction, but some sectors way more so than others. And the key variant when it comes down to having a material impact on value is really those movements in those face market rents, and it's industrials which are still the kind of key beneficiary in that regard, with those industrial rents up over 6% over the quarter. That's followed by apartments and other, which will be mainly self-storage. Contrast that with retails and offices where those market rents are pretty much static. You look at the change in contract rents just to the left of that, it's the storage, the apartments have seen more of that near-term pickup. You then have those projected rent growth rates or the projected growth rates, and these are changes in the projected 10-year average growth rates, which actually just below I've then opened up on a 1, a 3, 2, and a 3-year basis. So expectations here, you can see on a 10-year basis, are being clawed back for industrials, even more so from the apartments. And those downward revisions are primarily being picked up in a scaling back of those year 2 and year 3 positions, so reflective of, I guess, a slackening in the overall economic output. Offices, those growth rate expectations are also down across the board. Retails, the sector's technically still in recovery mode, has some near-term gain in the 1 year, but then that's partly counterbalanced by more downbeat views of years 2 and years 3. If you move across to this year 1 operating expense ratio, this measures change in projected operating expense as a percentage of gross anticipated rent over the course of next year. And that's trending down for a number of sectors, so kind of having positive impacts on value. So within this metric, on the numerator side, we're picking up near-term revenue increases for storage, for multifamily. Think of the multifamily where on the one side you've got the stress in the kind of ownership housing market, which then in the near term is further inflating the rental market. How quickly that might taper off, I suspect, may be a point of discussion, maybe for the next quarter's results. But for now, those near-term revenue gains are more than balancing out escalations in operating expenses. This metric, though, is still moving into the red zone, so here in the red zone when it comes to the offices, and that's part cost escalation, part ongoing rent concessions. And offices are also seeing on that right side there, that capital expense ratio, a larger increase in budgeted capital expense being modeled, and that's assumed kind of linked to the general realization the need to invest more into the office sector to ensure that it remains competitive in the wider real estate landscape. So in summary, or put simply, for offices, no real movements in rents, an increase in outgoings and rental concessions, putting downward pressure on cash flows. For retails, a little bit more green than red, compared with their office counterparts when you look at across those valuation metrics. And for apartments, for industrials, and for other, it's quite simply what's helping those cash flows strengthen, the improvements in those market rents, which is being tapered back to a certain degree by reductions in those forward projected growth rates. We've run the analysis for a 3-year basis, but I'm just conscious of time. And so we'll leave those slides and send these out. But I mean, I think the point to stress here is if you look over a 3-year, that appreciation spread, 25 percentage points per annum between the industrials and the retails. The spread is mainly on the cash flow side. I've used those cash flow metrics again here to highlight out the pressure points which are holding things back for the offices and the retails versus the up end of the market and the industrials. But maybe just polish off on the sector side of things, Robbie. I think we've got a question, and then we can get into the nuances and the variations within those sectors.
Yep, poll number 2, right? So which property type do you anticipate will experience the largest decline in the next 12 months, right? So is it apartment, multifamily, industrial, hospitality, retail, or office, right? So we'll give about 15 seconds. So from my perspective, this is a tough one, right? So in reality, if you look at kind of the dual negative is an office, right? So, but on the other hand, if basically cap rate compression refer, right? So maybe it is maybe multifamily industrial, right? So over the next 12 months, we like, again, there's a lot of positivity, like associated to cash flow side, but the question is it going to be pricing dominated or is it going to be cash flow dominated, right, over the next 12 months? So what do you think, Phil?
I mean, for me, the office market, you know, there's more frailty there on the cash flow side. So the other markets are clearly responding to those kind of cost of capital. I mean, the strategic concerns really, potentially lie in the office market. So
yeah, 67% pick office, right? So followed by industrial at 14 and multifamily at 11. So yeah, seem like pretty consistent with office.
Yeah. Thanks very much, everyone, for feeding into those polls.
Thanks.
We really do appreciate that. Okay, so let's move on. Hopefully my screen hasn't frozen. Brilliant. Okay, so now getting into a bit more detail, going back to the latest quarter, looking at performance numbers. And apologies, there's a ton of detail, a ton of colors on this slide. I think someone once duped it as a Super Bowl square slide, but that brings very little to a British man. But I'll take people's names on that one. But really, the color coding here is all relation to that 0.4% bottom right-hand side, which is the ODCE overall return. And we're breaking the returns down across the sectors, across each of the major metropolitan markets, ordered from west to east, and the color coding is what's north or south of that. So which groups are either elevating or which groups are reducing the overall ODCE performance number for the last quarter. And for industrials, if you just look across there, there's typically more greens than reds on the card, and that's maybe not as one-sided as it has been. For apartments, at the top there, the main talking point has been that dynamic that's been playing out between the Sunbelts and the gateway markets. We're starting to see a slightly less familiar look to the order in that respect. The likes of kind of DC, New York, and Boston are now in green, so they're now actually accretive to the overall index performance levels, whereas Miami and Atlanta the reverse. Offices, predominantly reds across the card there, so that's pretty binary in that respect. Retail's a bit more of a mix between greens and reds, and we'll actually look at retails in terms of subtypes as well. And in that other grouping, more greens than reds, and that's now in that leading property type. We'll also try and open that up into a little bit more detail as well. We'll switch up the color coding on the next slide. So that's, if you just focus on that Boston office return of 0.2, which is red and negative because it's below the overall ODCE of 0.4. If you actually then switch the color coding, so those colors are now relative to their respective sector averages, that trends in the green because Boston offices are at the upper end of the office sector. And this is the kind of detail we're trying to get into. So how much have returns varied within the sectors and why? Just a word for that bottom chart, which is the same on both these slides. That just looks at the Q3 return compared to the Q2 levels. And here we're seeing predominantly reds on the board as the vast majority of markets have effectively slackened off in the last quarter, culminating in a 3.2% reduction in returns overall in that bottom right-hand square. But we'll go through each sector by sector. So 0 on apartments, and I've outlined those first on the top and the bottom tables. So the top table again, color coding here is all relative to that sector average of 0.4% total return for the quarter. So the main talking points for apartments have been that power shift between gateways and the kind of improving Sunbelt markets, which may be starting to unwind a little. Yes, San Francisco minus 0.3, so that's very much in the red zone. Chicago 0.2, just below the average. So, but then, as I say, we're seeing New York, DC, and Boston all in the green, holding their own. And it's Miami and it's Atlanta, and it's Denver, some of those kind of stronger markets that we've seen in prior quarters, where returns turn negative, dropping off the pace last quarter. We've done a bit of a shake-up in the order. Robbie, I'll get your thoughts on that in a second, but either way, performance levels you can see from this bottom table are down on where they were last quarter. To get a better sense of the hierarchy, on this next slide, we delve into those variances, unpack the appreciation element of that return, and into those yield versus cash flow drivers. So in terms of the makeup of that appreciation, you almost have this immediate counterbalance between pricing and cash flow being played out pretty much across the board, almost to the extent that those two sets of bars are almost mirror images of one another. So where a market is gaining on the one hand with the strengthening cash flow, with the improvements in those market rents, those green bars, it's then losing out in terms of the movement out in terms of those pricing metrics. And in terms of the net difference, we're talking about pretty fine margins when we're looking at this one quarter. Markets at the base generally have seen a larger yield offset and not enough cash flow to counterbalance. I mean, Miami is really the extreme of that example. It's one of the strongest markets in terms of the strengthening of its cash flow. You can see there the improvement in market rents over the last quarter in Miami, kind of ahead of every other CBSA market, but it's got one of the larger offsets in yields, and that's what sent the appreciation negative for the quarter. Thinking of Boston and New York, which kind of called out as two markets that have moved into the green zone there, up at the upper end of the hierarchy. Now, in terms of cash flow, these markets are still pretty muted, but what's helped them prop them up the order is a smaller order of magnitude in terms of the yield offset they've seen during the quarter. So in terms of the general takeaways, it's the stronger markets on the left-hand side. That's just some of those I've circled up that have seen more of that rate compression in prior quarters, that now experiencing more of that reset. So with those larger orange bars highlighting up Miami, Atlanta, Denver, even Dallas at the top there, where you've seen the larger offset in pricing. But it's also worth noting that then on the right side there, for the gateway markets, which I've just circled up in terms of New York, San Francisco, Chicago, down the bottom there, Los Angeles, they're still relatively weak when it comes to cash flow gains over the quarter. So maybe, Robbie, to you, I guess when assessing the hierarchy, there's a risk in drawing too many conclusions from one quarter, but slightly less familiar feel to the order. That shake-up looks to be more on pricing still. Do you expect to see maybe a bit of a leveling out on the cash flow side of things? So general observations there.
Yeah, I think that in a previous quarter, you get some pricing movement here and there on cap rate compression. Majority come from the cash flow. So cash flow tend to dominate the ranking, right? So in this time around, it's trying to mute it some of that that increase on the cash flow side. I think high level for the apartment side, there's still a lot to be like, right? Basically on the cash flow front, right? So we talk about lack of availability, that's help kind of pushing apartment rent, lack of new construction, right? So this also will help connect apartment rent going forward, right? So definitely kind of in the sense, and just especially in the apartment side, appear to be a good hedge for inflation, right? So previous quarter, we talked about correlation on kind of return apartment and the NOI associated to employment, right? So employment and growth, right? So and so that's why like people still like the Sun Belt, like employment growth are still pretty strong on that basis, right? So, but uncertainty on with the potential recession that you indicated earlier, then make people taper down the market rent growth. As you can see this time around, that's pretty much all red on the market rent growth side, right? So it's more reflecting in the sense the potential recession, slowdown in employment, right? So, but overall, people still like the Sun Belt in the cash flow front. It just basically some of the cap rate compression that happened the previous quarter have been reverting back a little bit as well. So.
Okay, thanks very much for that added clarity there, Robbie. We have got a 3-year slide. It really just confirms the status and the standing of those Sunbelt markets at the top end of the hierarchy. The variances really on the cash flow side of things when you're looking at the gateways versus the Sunbelts. If you look at the movements in those contracts and the market rents, pretty tepid down below, much stronger up top. So, but just wanted to maybe move on to the industrials. So moving that kind of shading down to the industrial sector, you can see also from the lower table, notable slowdown in industrial returns across pretty much every CBSA market, kind of culminating in that drop in overall returns of just over 5%. The top table then looks at the actual Q3 returns. Some of the coastal markets still leading. So if you look at the green, LA, San Diego, coastal markets, Miami, also comparatively strong at 3.5% return. New York, which has been a serial strong performer, 0.9%, still kind of standing its ground. But there are certain markets now, though, that are starting to really struggle. More inland, Denver, Dallas, negative rates of return last quarter, Houston, Chicago, pretty tepid performance numbers and appreciation there, levels there, turning negative last quarter. And actually, if you get into the detail of the appreciation for the quarter, this is breaking it down into those oranges and blue, those yield and cash flow components, which is effectively the makeup of the appreciation. You can see first off that those orange bars, those yields are negative. They're increasing, offsetting values across the board. But what stood out for me was just how static a number of these industrial markets have been this last quarter. And that's really a product of most of those pricing offsets being mitigated by improvements in cash flows, and those improvements in cash flows are effectively picking up those green bars, those improvements in market rents. You've effectively, if you look at the scaling down below here, you've got a kind of 4% trade-off from yields versus cash flows. Values are still in the ascendancy in a couple of those kind of key coastal markets, Miami, Los Angeles, where you've got those stronger cash flow metrics, and here market rents are moving ahead more so than other CBSA markets, where down the bottom, down below, those cash flows have increased by lower levels, and it's in a number of these kind of inland markets, the Houston, Chicago's, Dallas, and Denver, where with those lower cash flow upticks, then those movements out in yields have actually then resulted in values being cut back over the quarter. Another general point to note with the industrial market, as well as yields moving out, we're also seeing a tapering back of those market rent growth rates, those 10-year averages, which have effectively been stepping up quarter over quarter. We're starting just to see them being factored down and show they're still significantly ahead of where they were 3 years ago, but just kind of slight slowing there, possibly indicative of the slowdown in the wider economy and how that may percolate through into the industrial sector. So Robbie, with that kind of current cash flow protection that we're currently seeing there still in place, but if we are potentially looking at further write-downs in industrial values, is that more yield? How might the cash flow aspect continue to play into that?
And yeah, I think on industrial, it's no longer sunny Southern California all the time, right? So there's some cloud nowadays as well. So they're definitely headwind for the industrial side. Do I look at vacancy are still really tight, generally for the industrial front. So you can see that that's why the market rent are still positive, right? So granted, I think that the headwind with economy is going to impact it as well for the industrial front. So you can see the negative on market rent growth side, right? So, but fundamental, people still feel comfortable in there, right? So the yield effect, basically, as you can see, even my previous example, right? So the longer term leases one appear to have more movement in cap rate, right? So I think that you're going to see more impact on basically the longer term. Well, first of the shorter term leases is still seem to be transacted, right? So as long as you're comfortable with the rent you can get, basically when you roll, right? So and then that's can basically in that sense people feel comfortable. But longer term is that's the tricky part about it. That's where the capital market movement much more impact on a discounted cash flow basis.
Thanks, Robert. Again, we've got a 3-year slide in here as well. Just flash that up, but we'll leave it in the deck, and really it just confirms the status of some of those really strong markets up top, Southern California, New York, and it's again the cash flow aspect that's really driven the appreciation over 3 years, more so than the pricing. So that really does kind of put a comparison between those two levers on appreciation. You see the extent to which those market rents have changed, have moved up over the 3 years, 75 percentage points up to 150 percentage points when it comes to Riverside. Robbie, you mentioned the leasing part there. Just very quickly, we've run some analysis. I think we showed it last quarter as well, to look at whether there was kind of a variance associated with lease lengths when it comes to the industrials. And certainly it feels that the longer lease properties possibly aren't being able to kind of fully capitalize on the extent of some of the market rents that have been coming through over the last 3 years. So if we just run that here for Los Angeles and put a trend line through there, you can see that, I mean, the shorter the lease duration, the more upside you've seen on appreciation over the course of the last year. And the longer lease is not immediately translating itself into appreciation because we're not able to fully capitalize on those movements in market rents. And we can do this for a number of sectors. In the interest of time, moving on to offices, arguably the most challenged and the most talked about sector. Quite a number of negative returns last quarter. Usual suspects: New York, DC, Chicago, San Francisco. Dallas also negative. Miami, which has been a comparatively strong performer, also dropping negative 1.5% return last quarter. And returns in most markets being tapered back over the last 3 months. Here, the variant on the appreciation side, and those appreciation returns are net negative across the board. But the size of those red bars, if you look at the scaling here, is really all about the yield more so than the cash flow. So if you look at the bottom end, San Francisco, Chicago, New York, and Miami, it's those yields that have been moved back, that have been moved out, that are cutting back valuation levels in the last quarter. In broad terms, general observation, cash flows are contracting, growth rates are being factored down. You've got an increase in that operating cost to revenue. But this is the sector we are seeing this dual negative being played out, where value declines are both cash flow, but more apparent in the last quarter, I guess, there, Robbie, on the pricing side. So what's your general read on the market sentiment that's being played out, offices and into different parts of the office market?
Yeah, I think it's continued to be uncertainty in this office market, right? So, in office occupancies remain relatively stubbornly low at like 47%, right? So people think after Labor Day is going to pick up, but it's still relatively low at 47, right? So therefore, the future cash flow is much more uncertain, right? So that's why you continue seeing that market rent growth is going to declining as well. So the cash flow relatively muted, right? A lot of them actually in the negative cash flow front. Do I look at office? I kind of categorize into two buckets, right? The have and have not. The have typically called the trophy office. We heard about the trophy office signing leases and high rent, right? So you get the life science building, get the MOB, right? So that's generally holding up better, right? So the have not is still the big question, right? So the commodity office, especially the one with lower occupancy one, that's the one that we know that individually they have a big write down, right? So if you go to the next chart, Phil, on the 3-year basis, you can see actually the gateway kind of office in the left chart here, like New York, Chicago, they kind of can average appreciation annually is -5, so which means that over the last 3 years, you're talking about an average write down of 15%, right? So or more, right? So But the issue is basically that write-down typically happen on the smaller value asset, right? So versus your trophy asset, your life science assets, in a sense, cover like a lot of that losses. So as an aggregate in the office, people might not see that much write-down, but in reality of it, there have been write-down in a lot of gateway office market.
Okay. Thanks a lot, Robbie. And the other side of this, well, as we did with the industrial, and I think we showed this last quarter, we ran an analysis within those CBSA markets to see how lease terms maybe influence those appreciation levels. So 3-year annualized appreciation, we've just taken a sample of properties here out of San Francisco, and there does appear to be some level of correlation in that the shorter leases, the more the near-term roll, the more an asset is subject to those declining market forces. The longer the leases, the assets are afforded a degree of protection. Across the retail sector, changing tact here. For retails, we look at things primarily by subtype. General narrative on Q3, yields are moving out, cash flows continue to strengthen, regional malls with more of that net deficit. At the top, those neighborhood kind of grocery anchors still moving in the right direction from a valuation change standpoint. If you look at things on a 3-year basis, still a lot of ground to recover for most retail subtypes, more left side than the right side on those yield and cash flow charts. Neighborhoods are generally holding their ground in terms of cash flows. So cash flows for neighborhood grocery anchor centers are net positive. You go back to the start of the period of the pandemic, but obviously that the malls are where there have been the larger write-down. So Robbie, that's getting 3 years, but what's your kind of latest read on the retail sector?
Yeah, I mean, over the past 3 years, we talk about retail being more negative throughout, right? So it's kind of weird to kind of in this quarter, we talk retail are not that negative overall, right? So there's still a lot of positivity. There's some positive factor to the retail side, right? So grocery anchors holding up, right? So with inflation story, the grocers are able to pass through kind of the higher costs as well to consumer, right? So and then if there's recession, people are going to shop more as well, right? So shop more in the grocery, what I meant, right? So less going out per se. Right, so what I mean even here, kind of on top of that, so the cap rate generally higher than other property types, so you see more muted in terms of the yield effect, right? So overall, more positive than previously, still facing the same headwind as anybody else in any other asset type, right? So generally.
Okay. Thanks, Robbie. Okay, just conscious of time, we want to get some Q&A, just a slightly different lens into the sectors. Now, as well as by subtype for retail, we could do similar things for apartments and offices. As say, NCREIF are running some reclassifications, so we'll be able to strengthen this out going forward. But just on immediate observation for Q3 for the office markets, those CBD downtimes, that's really been the focal point of the decline. Some of the suburban markets also struggling. SPD secondary business district, maybe more of that modern stock holding up slightly better. On the apartments, all seem to be relabeled the residential sector. You've got those garden properties kind of setting themselves apart from the kind of more urban low and high rise. We have been able to kind of separate out some student accommodation. So these bars are the levels of return. So student accommodation kind of proving their worth with those return levels in the last quarter. In the offices, I should have called out, we've separated out some of those MOB assets, and they're kind of holding up well and actually accretive to the overall ODCE. The overall ODCE is marked out that by that dotted line. The numbers down the bottoms of the actual weights. And then in the other, separating out self-storage, that's definitely the leading element there. Hotels, only a slither of ODCE funds invested in hotels, but that's bouncing back well. And healthcare also proving to be relatively resilient. Conscious of time, Robbie, so one last or two more polls, isn't there? And then see what's come through the chatter line.
Thanks. Yeah, similar to last quarter, right? So knowing the return, 3Q 0.4% on total unleveraged, what do you think the 4Q for ODCE return look like, right? So is it positive movement, i.e. 1 or 2%? Or second is basically appreciation with 0 to -3%, so between -2 and 1% kind of total return. Or is it an appreciation between -3 to -5? So, or worse than -5, right? So that's the four choices. Give about 10 to 15 seconds. Definitely, my point of view, right, Phil, there's going to be negative, but the question is how negative will that be, right? So
it feels like we're following that trajectory at the moment.
Yep. Okay, let's see where it lies. So generally 48% between basically 0 to negative 3% appreciation, Phil. So again, the continuation of that kind of trajectory, right? So 37% choosing between negative 3 to negative 5% appreciation. So there's 11% of people thinking it's negative 5. So it's 4% thinking positive though, surprisingly.
They may have some sector specific stuff in there.
That's true. That's true. Yep.
Main takeaways. I don't think we need to read those verbatim, so we'll leave those in for people to kind of to pick through. But hopefully that summarizes accurately the main points that we've been talking through. Final poll question. Robbie, do you just want to take that one away, and then we'll see if what has come through in the Q&A. And
Sure.
and if we won't get to everything on the Q&A, so what we'll do is we'll review the document and send it out to everybody in terms of the general questions that have come through.
Yep. Again, thanks for everyone to joining, right? So, I mean, the final Q&A is basically, do you find the information presented today helpful in managing your overall business process, right? So, yes, and your firm is already an Altus client. Yes, your firm is not an Altus client, which means you will expect a call from Altus sometime, right? So, oh no, not applicable, right? So again, give about 10 to 15 seconds. And I know that there's a lot of questions being posted, and some of you guys have put question. We know that we'll be meeting you over the next kind of like 2 to 3 weeks, right? So I might not answer all this question in here, right? So, but to some extent, that basically, again, like we will try to answer as much as we can. So if any question that's not there, we'll connect answer them separately. If it's not during a one-on-one, right? So
we'll summarize a dossier of all the questions that have come through and responses, so everyone gets to see the full extent as well, because obviously can't really do it full justice. So yeah.
Perfect. So first Q&A, Phil, like, so on your chart on that, the allocation chart, the distribution of kind of like a weight, right? So do you know how many the increase on industrial, is it come from value change or is it come from acquisition majority of the time, Phil?
Yeah, and we've just been working with NCREIF around this information, so thanks to them for providing us with a little bit of extra detail on this one. I mean, as I said, those sector swings are primarily down to kind of variances in performance levels. We actually did dig the numbers for the industrials. I think if you go back for the lot till about 2018, you got about 30 billion of acquisition on the industrial side. But if you look at the movement in the same store values, you've got about a 50 billion shift in value. So the gain in that industrial weighting is definitely kind of, it feels like 60-40 kind of investment performance versus just if you just take the pure purchase piece, but then the net investment would take off the sales as well. So it really does feel to me that the weight movements are driven by kind of the performance levels if you think through the industrial sector and what the numbers that we've seen there.
So one question talking about basically the negative appreciation in San Francisco office. Is it being offset by life science? Do we know this figure netting out life science? I know that's kind of a topic since previous quarter as well, like a life science component to the office, right? So
I think it's a topical question because, and thanks for the good work from NCREIF in doing the reclassification around this, because as I say, some of those life science MOB properties we know are falling into other. The vast majority of them are falling into offices, and when you look at that San Francisco number, especially in prior quarters, and San Diego, it's been propped up by that life science piece. My understanding is once we've gone through that reclassification exercise, everybody's putting them in exactly the same places, we'll be able to kind of reverse it out. So we'll be able to look at the pure office return or the office return without MOB and life science and separate that out. But at the moment, as I say, we're not quite able to get there just yet. I think, without stealing their thunder, NCREIF may be wanting to put some of that information on the screens at their conference in Orlando. So I'll be looking forward to being at that and seeing folks there.
Yeah, maybe I'll put one last question. I know, considering of time, right? We don't want to take too much time from everyone here, right? So I think this is more comment on the office. What is the can you comment on the office contract rent relative to market? How do you expect the balance to impact cash flow effect over the next few quarters, right? So I'll take this one, right? So basically, again, this is a tricky one, right? So because if you look at it like contract versus market, like a lot of the recent renewal tend to be close to what the contract is, right? What market rate is. So they have higher TDI and higher LC, more kind of free rent perspective, right? So that's why you see, and the cash flow have been relatively stable, some negative here and there. Do I expect that to kind of go negative? Possible, right? So a lot of people are now thinking the office usage. What is the office usage going to look like, right? So that's definitely, I think the office is definitely the biggest question mark out there, right? So we know that if you look at the trophy office, just look at all the news on One Vanderbilt, right? So there's everybody signing leases, 150, 200 bucks a foot. There's a big occupancy. There's a lot of leasing. There's a lot of news also leasing in the office side as well, but there's still a lot of uncertainty. We talk about technology company pulling back on the office space here and there as well, right? So, but yeah, we're definitely gonna continue to monitor that over the next couple of quarters. Okay. Any closing thought, Phil? I know that definitely there's a lot of question out there. We will definitely kind of respond that over email, right? So or one-on-one chat that we have basically our clients. So closing thought, Phil?
No, nothing really other than just yeah, interesting. I'm delighted that people were able to engage in those polling questions because it's good to get a mood of the market where we're sitting at the moment. Yeah, and as Robbie said, looking forward to taking this conversation with clients forward on a one-to-one basis, and we seriously appreciate everyone's interest in this analysis. So if you want to understand more and you're not already engaged with us, please do get in contact. And otherwise, we'll either see folks at NCREIF. We'll be talking to our clients in the months ahead, and we'll be rerunning this webinar again on the Thursday, the first Thursday of the second month. So I'm trying to now kind of come up with that date live in my head. So that'll be on the, I think it's on the 5th of January. 5th, no, February. The 2nd of February. Let's send that out. Don't trust me with that one. But thank you everybody for your time today. Have a safe and enjoyable rest of the week.
Thank you all.
Thanks, Robbie.